Hi everyone, I hope you're all doing well, and today we talk about 3 UK stocks to buy in September 2020 edition. And this is probably one of the most popular video series that I do on the channel, this one in the US stocks. It always brings in quite a lot of viewers. So thank you for coming onto the channel, guys. We're pushing towards 4K subs, so if we can get there hopefully by the end, hopefully towards the end of this month, that'd be absolutely amazing. So if you're not subscribed, make sure you hit that red button, guys. And for you guys that are always around here, make sure you smash that like button, guys. But we'll get stuck into 3 UK stocks to buy in September 2020. So I've actually tried to change it up a little bit, guys. I don't want to, carry on about the same stocks all the time. As much as I love Greg's, I didn't want to put it back in this list. And same with some other companies, guys. I don't want to carry on, bombarding you with the same companies. I want to kind of give you some more companies to add to your watch list to keep tracking, and some of you guys might really like these 3 companies that I'm suggesting today. So we'll be talking about them, guys. So yeah, there's no Greg's on this list, no kind of Hollywood Ball, no Dark Group. Kind of giving you 3 different companies to have a look at today, guys. So I hope you enjoy the video, and I'll get stuck into it. So first on the list is a company called Trainline, and Trainline basically is a site that I actually use quite a bit, and I'm sure some of you guys use it quite a bit when you're trying to travel on trains, but they also do other services as well, and also not just based in the United Kingdom. But I think this is a really good website, a really good company that's you're able to compare times to prices. Really useful if you want to compare different ways of transport as well. So I'm a big fan of the product and the service they do, and like I say, I think that if they carry on expanding internationally and obviously more and more people start using the platform, this company will do really well. When you look at the earnings that they did only a while back before COVID, you'll see that they actually were growing very well, and the stock as well was doing quite well pre-COVID. And then when you think about Trainline, obviously transport probably going to get hurt quite a bit, so obviously this is one of the stocks that we expect to sell off absolutely huge, but one of those that as soon as September comes and people are traveling again, a lot of people are back in education, gives a lot of people, parents, the ability to go back to work, go back to the offices. I think it's one of those that will start picking up quite a bit in September. But before COVID, this stock was about 550-ish. The stock dropped about 50%, and this actually went into the 200 range. And then the stock actually had a very sharp recovery, probably a little bit too much of recovery, and went up 100+%. And then the stock has been downtrending since, and it's probably come to the realization that this company, you can't trade this company at pre-COVID levels with how much it's been affected. And since it actually got back to nearly breaking all-time highs, the stock's actually dropped another 25%. So you you might have missed out on them COVID lows, but it's a nice support area here. So yeah, you look at the stock, you might have got a second opportunity to buy into this company. So when we look at the actual earnings growth on this company, it was a company that hasn't really made profit pre-COVID, which is probably the only negative about it. It actually got quite close in towards like the start of 2019, and now it looks like it will probably be making profit towards 2022, 2021. So it's not too far off profitability, which is a positive. I don't like buying into companies where you're just buying the story because they're never going to make money. This one looks like it is getting quite close to profitability side of it. And when we look at the revenue growth side of it, obviously they're being focused on the revenue over the last few years, and the revenue has grown 20%-ish. And then after COVID, we'll actually see revenue start going back up again. Same again, growing at about a 20% rate, and like I say, we'll have profitability. So from the revenue side of it, it has been decent, and then from the profit side of it, it looks like it isn't too far away from profitability, which is obviously a positive sign. On the balance sheet wise, the balance sheet wasn't amazing a few years ago, but it has started to get back into a better place. The debt to equity ratio is about 38%, so it's getting a bit of a healthier balance sheet. It has 92 million in cash, 141 in debt. So like I said, it could still be a little bit better, but still there's a bit of cash on there, and at least the balance sheet is moving in the right way, which is a positive. There was no insiders buying during the COVID. I guess that's kind of a little bit of a negative, but it's better than people selling. So overall, there's not loads of insiders there, like say making any moves, but it's not a bad company that's dropped quite a bit recently, so it might be, you know, an interesting one for your watch list. Number 2 is actually a company I own, and I was actually quite close between this one and putting Legal & General in. It was a bit of a toss-up between really, but I decided to go for this one. And number 2 is Aviva. Now, everyone kind of knows Aviva. It's one of those that is insurance. A lot of different other products as well, but you know, obviously insurance is probably the big one with Aviva. And you think about insurances, obviously people, whatever happens in the world, still need insurance. So it's obviously quite a safe company. And obviously when you think of Aviva, obviously insurance, there's not going to be massive growth in this kind of area, but it's one of those that's an essential really, isn't it? You know, so it's always going to be, I think, the need for Aviva to be around. Like I say, when you look at a long-term point of view, the stock hasn't really done much because, like I say, once again, you know, when you talk about these sort of insurance companies, financial companies, you know, there's not much excitement there because, you know, the revenue isn't growing huge. That's, you know, it's not going to attract loads of buyers in. It's one of those that you're probably looking at more towards like a dividend side of it. And the company was trading around about 410 pre-COVID-ish. And then obviously it had a massive drop, and then it went down about 50%. And it's slightly been recovering ever since the COVID lows. But when you still look at the stock chart, you know, you're still getting the stock at about a 30% discount. So it's still pretty discounted at the moment, and the ticker symbol for this one is AV. So when you look at this one, PE ratio stands out as being extremely cheap, a PE of 5 compared to, you know, the industry market. So it is a very cheap stock. Like I said, the big thing that puts people off is probably because it's not going to be, you know, growing huge on the earnings and revenue front. And then when we look at the earnings and revenue front, you can see revenue a little bit choppy for, you know, obviously it was an insurance company depending on how many claims and everything like that, but on the earnings front, once again, you know, it's steadily grown its earnings. You know, it's not terrible. You know, you look at the company, you know, if you go back to 2017, it was a company that was making 1.2 on the earnings front. And then obviously over the last kind of 3 years, it's actually been able to double it. So it's been a bit up and down, but over a long-term kind of view, it has increased its earnings. And same again on the revenue, it has increased its revenue. When you look at the company's balance sheet, pretty much what you would expect for a company in this sort of industry, you know, 53% debt to equity, which is definitely, you know, investable. That's an okay balance sheet. You look at the debt, 9 billion, the cash, 19 billion. So it's nearly double cash to debt, which is, I think, you know, it's not like, wow, really good balance sheet, but it's still a very healthy balance sheet. So that's pretty good. I think it is still paying its dividend slightly. It currently says 5% on Simply Wall Street. I don't know how correct that is, but it is looking like it is still paying its dividend. And also, if you look at the safety of the dividend, it's a pretty low payout rate at 51%. So it kind of suggests the company can afford to carry on paying out the dividend. The only little red flag that I did see with this company is the amount of insiders that sold in COVID rather than buying. That was probably the only thing. So yeah, you'd probably like to see people buying a little bit more in the COVID lows, but yeah, there was only people selling. But overall, like I say, I think it's one of those that is a little bit too sold off, so you could see some share price gain. And also, I think you'll probably pick up a bit of a healthy dividend with this one. And the last one is JD Wetherspoons. Now, I could argue that I could have put City Pub Group in this instead of JD Wetherspoons, but JD Wetherspoons is a popular one, so I thought I'd go with that one. And obviously, we're talking about a company that is obviously, well, has pubs. It's a company that is definitely in the news quite a bit, politically wise, and I've always said on the channel that management could, just chill out a little bit, maybe not go on Question Time as much and get involved in a lot of political stuff. So yeah, it's one of those that does have the headlines quite a bit, but at the end of the day, people are still going to go to it. The punters that still go to it are still going to go to it. And it's always going to be busy. I think when I've gone past a few Wetherspoons near me, they've still been quite busy inside, so they seem to be doing okay. I've got to say, probably not the best at social distancing when I've gone past, but at the same time, even you question whether it's right or wrong. The thing is that they're allowing more customers to come in, and the revenue probably would be quite close to where they will be or would have been at, like pre-COVID levels. So it seems okay from that side of it, operating. Customers seem to be there. I think the only bit of worry around this one with Wetherspoons is that there's that kind of fear that if the cases start spiking up a little bit, the pubs could be closed, because obviously one of the first ones to open up could be one of the first ones to close. You know, the priority to keep the schools open. So I think that's kind of one thing that is hanging around it a little bit. But overall, it seems like it's doing okay at the moment. So the ticker symbol for this one is JDW, and it's currently trading at about 980-ish of recording this video. Pre-COVID, it was about 1,600-ish. And generally the stock had done, you know, well pre-COVID levels. It was always a company that was increasing its revenue, its earnings, and therefore attracting a lot of investors in, and the stock price had reflected that over the last few years. But since COVID, the stock has dropped about 60%, so it is, you know, massively sold off, and it has recovered a little bit now, but it's still quite sold off. And like I say, I think like when you look, it does have a P ratio of 16, so it's still a little bit of a premium, but nothing terrible. Like, I still think like when you look at this stock, you probably look at and say that it's probably got, you know, a good 40-50% upside at least from here, maybe a little bit more you could argue. So it is still pretty sold off. Not the cheapest of valuations, but it's still, I think there is a little bit of upside in this stock right now when you look at these sort of prices and how much it did sell off. So when you look into the actual growth of the company, you'll see that the earnings have, you know, steadily grown. The revenue has been a little bit better than the earnings. The revenue has kind of increased a couple of percent every time. And then we have the drop in COVID, and everything after COVID looks like it will recover and once again go back to a little bit of earnings and revenue growth in the stock, which is always a positive. Debt to equity isn't amazing. The debt's 900 million. Debt to equity is 286%, which isn't great. The cash is 47 million. The debt is 900, so the balance sheet isn't that good. So yeah, that's only a little bit of a negative there. But I'm sure that will, you know, now it's operating again, I'm sure that will kind of level itself out. It was a company that did pay a little bit of a dividend, not much, but it's cancelled that to save cash. But it was a, you know, pretty low dividend, low payout rate, so you did kind of get a dividend with this one. And when you look into the insider front, Tim Martin has actually sold quite a few shares recently. So I don't know if that's something that he might have seen in the stock, being inside, but actually into the COVID levels, there was a lot of people buying the shares. So with Wetherspoons, like I say, it's personally, I don't think I'll buy into Wetherspoons just because of like, I don't think there's that much upside really in this one. But it's still, you know, I would definitely still rate it as a buy. Like, it's still got upside from here. Just it doesn't have enough to interest me to go into it, but it still might be one for you guys on your watch list. I would also say that City Pub Group is probably one to add to your watch list as well. So hopefully, I hope you enjoyed the, you know, free UK stocks to buy September 2020. Hopefully gave you 3 stocks that you might want to add onto your stock watch list. And as always guys, if I do buy any stocks into September, I will let you know and I will make a video about it. But that's the video for today guys. I hope you enjoyed it. Remember, subscribe if you're new around here. Like the video if you can guys. And I'll see you in the next one.